Hey there everyone, this is Kirk here again at optionalpha.com, where we show you how to make smarter trades. And in tonight's video, we're going to go over all of the trades that we made for Thursday, April 9th. So it was a pretty active day, and more so on the closing and hedge side. We had some new opening hedges and a couple closing hedges that I wanted to cover tonight. So no brand new trades that we get into today. Everything actually was working pretty well, so there was really no need to kind of, step in front of things that are working really well, right? So everything was going pretty much the direction that we wanted, most cases, and the portfolio was up a couple $100 today, which was nice. So with regard to closing trades, let's first talk about BBBY. So this was our earnings trade from last night. You can go back through the video tutorials right down here below, and you can watch all of the stuff that we had gone through to enter the BBBY earnings trade, and it worked out pretty nicely. The stock opened up inside of the expected range, which is what we wanted. We were able to close this thing out early in the morning, a couple minutes after the market opened, for a $27 debit. So took in a nice 80-something profit. I don't know why I didn't write it there, but it's a nice little $80 profit. I'll update this, so it should be updated before the video goes out here. But a nice profit on BBBY. You can see why we made money, again, because of this implied volatility crush, right? I mean, this has been known to happen, and we knew that it happened many times with Best Buy going back, or I'm sorry, Bed Bath & Beyond going back before, and with implied volatility right before earnings up in the 100th percentile, it was really easy to get into this trade and sell some premium. And again, our short strike down below the market was at 72, so it wasn't even close. It kind of got close towards the end of the day as the stock really fell. But even if you had something and held it throughout most of the day, you still ended up with a nice winner for a one-day trade. And again, it's really hard here to sell or to buy implied volatility heading into earnings, because you would have had to buy this thing and hold on to it for the better part of a month, right? It didn't really go anywhere for the better part of a month. So this is why I tell people it's really hard, and not that it can't be done, but it's extremely hard to buy a strangle or buy a straddle heading into earnings and try to take advantage of that implied volatility move higher, because now with implied volatility already high, and assuming that it stayed high all the way through earnings, you really are bound to directional risk of the stock. The stock moves one way or the other, right? And in some cases, that doesn't necessarily help you. In most cases, it will if you buy, but in this case, you would have held on to the stock basically from here all the way through earnings, and the stock basically went nowhere if you bought implied volatility during that time period. So it's a really hard trade. I think the easier trade and leaving your capital less at risk, because you only have it at risk for a day at most cases, is to play the implied volatility crush. So really good example here with Best Buy. And again, please go back and review that trade if you need to for earnings trades. Now, we did make a couple of adjustments. The first one is a closing hedge. Now, this closing hedge in FXE really wasn't anything other than just trying to exit the position. And since we had the Iron Condor, just one of our Iron Condors for FXE in April, we didn't want to go ahead and exit the whole Iron Condor because our two long legs were practically worthless. So our 110 call and our 101 put were practically worthless. There was no point in exiting those because the commission cost would have cost more than we would have gotten back from selling those back to the market. So all we did was bought back the inside legs, which are 109 short call and the 102 short put. And so we paid about 8 cents in debit, but that also leaves us some long legs that kind of help this position overall. So again, all we did was buy back the interior legs of this FXE Iron Condor, and you can see the interior legs that we bought back. Let me just make sure I'm looking at the right one here. The interior legs that we still have long are these ones right here, which are the 101 puts, like I said, and then also the 111 calls. So you can see we're basically left with a long straddle or a long strangle in this trade. But again, it's practically worthless. It's not going to decay in value at all, but it does, keep us, I guess, open to the market. Is basically free trade that we have left on here. Keeps us open to the market in hopes that, if there is a pretty big move in one direction or another, we actually do stand to make a profit. Not that we expect that to happen. But overall, we'll kind of summarize the total profit in FXE. This was a profitable trade in this Iron Condor. It looks like the whole thing should be profitable, but we'll summarize that towards the end of expiration. The other trade adjustment that we did make is to roll up for the second time our BIDU, which is Baidu, our BIDU short put leg. So For those of you who've been in this trade, I'll just recap it. And for those of you who haven't, this will be good learning experience. But we were in a put calendar spread in Baidu at the 195 strike. So if we go to the charts here and we just bring up Baidu, you can see that we were at the 195 strike, which is all the way down here. Now, this put calendar was assuming that the stock would do two things. One, fall to the 195 level, because that's right in here, and that implied volatility would go up. Now, we got implied volatility moving higher. That's great, but the stock's moved completely against us. In fact, it's gone completely the opposite direction. So here's what we've done. So we've taken the 195 strike, and the first adjustment that we made is we rolled it up to the 202.5, which is right in here. So we made our first adjustment pretty fast and pretty slow as far as distance, or conservative as far as distance. Took in a nice little credit to roll that trade higher. Now that the stock has moved even higher than that, now we've rolled this position up even further to the 210 strikes. So now you can see we're getting closer and closer to where the stock currently is trading, because if it continues to move in this direction, we want to reduce our downside risk of Baidu continuing to move higher. So again, just continuing to roll this trade up higher and higher and higher, and this gives us more and more credit. Now, this is the resulting position. It's a diagonal spread, and everything is really pinned on 210. So if the stock actually falls back to 210, we actually make a little bit of money back on this trade. So ideally, that's kind of what we want to happen. We want to see the stock actually move from about 218 back down to around 210. But at this point, we're just playing defense, right? We've got 8 days to go until the expiration cycle ends, so we want to continue to roll that trade up. And what we did is, again, rolled up from the 202, which was somewhere around here, and just rolled that up a little bit closer to where the stock is trading at 210. Now, here's the deal. We entered this trade for about a $360, I believe it was, debit. So it cost us $360 to get into this trade. After these adjustments that we've already made, our net cost, because the credits have helped reduce the cost on this trade, is down to around $213. So that's about a 40% reduction in our cost to get into this trade. Or if the worst case scenario happened and Baidu continued higher, we've already reduced our possible loss by about 40%. Now, if we were to exit this trade today and sell it back to the market, whatever positions we have left, we actually would probably lose about $80, $90 or so, depending on pricing. So we're still not all too bad in this trade, and definitely making adjustments along the way has really helped out. Last adjustment that we want to go over tonight is a trade that we've had in for a very long time. This is one of our contingent orders. We actually put this order in about a month ago, actually over a month ago. I think it was March 8th is when we actually put this order in to fill. And we did this right after we entered the trade, the original trade, which was our TLT custom naked sell. It's basically an iron condor without this long call leg. So we had a short call above the market, and then we had a put spread below the market. Again, so we had a short call above the market. We were totally naked above the market, and then below the market, we just had a credit put spread. So all we're doing here by buying back this one single leg, this 135 call, is creating an iron condor. Now, we bought it back for less than our total credit received on the original trade. The original trade, we took in a 12-cent credit to get into that trade. So because we took in 12 cents, so long as we can buy the protection for less than 12 cents, which we did, we bought it back for 10 cents, we are turning this trade into a iron condor that has absolutely no risk. It has no possible price at which TLT could trade that we could lose money on this particular iron condor. So it's a really good adjustment and a very, very cool adjustment to make. And it's taken a little while to kind of materialize here, but it's definitely been very, very helpful for us. So again, here's our original position. Here's what it looked like without that extra leg. Let me just actually just make this a little bit wider here so you guys can see it. So you can see we have what looks like that credit put spread down below the market, and then we are completely naked, or were completely naked above the market. So all we're doing here is just buying protection right here at this 35 strike. We had the short 134 calls, and so now we're basically creating an iron condor from this point forward. And that net cost, again, is less than anything that we took in credit. So now we have a completely risk-free trade. We didn't need to do this necessarily. We could have definitely saved the $10 because it looks like it's going to be a complete winner, overall, and we're going to make a little over $100 on this particular trade. But it's always better to make this type of adjustment because you don't know what's going to happen. There's a number of things that could happen heading up to and even including the week of expiration. So it's always the prudent thing to do to hedge a trade and to adjust a trade, especially if you can hedge it into a no risk iron condor like this. It's a really, really great strategy going forward. So as always, I hope you guys enjoy these videos. If you have any questions or comments, please add them right below this video inside the membership area. That way everyone can see your questions and see the responses so that we're all learning here at the same place together instead of through email. And if you're watching this video online somewhere else, on YouTube or someplace else, you just have to understand that you're getting this video about 15 to 20 days after it's sent out to our members. So if you want real-time alerts like the ones that we went through in this video and a video that goes along with those alerts every single night, you've got to sign up for a membership at optionalpha.com. Until next time, happy trading.